Today we are covering EPAM Systems, ticker EPAM. Over the next few minutes, I'll discuss my thoughts with valuation of this company and its business quality. This company has a market cap of $18.8 billion, enterprise value of $17.2 billion, so you see about $1.5 billion in net cash. That's a very good sign, operating in the IT services industry. We can go to the business description. They provide digital platform engineering and software development services worldwide. Tends to be a pretty good business. Offers engineering services, requirement analysis, platform selection, infrastructure management services, software development, testing, maintenance support services, offers business expertise, design, solutions, serves financial services, travel and consumer, software, high-tech, business information, various industries. So, headquartered in Pennsylvania. Lots of different information there. Doesn't tell you a lot about what they actually do other than their services business. They're dealing with software, they're dealing with platforms. You see consulting in here. Tends to be something that shouldn't require a lot of capital. We'll see if that is true as we dive into the numbers. Beta of 1.59 is significant because that means it's going to be about 60% more volatile than the average S&P 500 company. That volatility is normally linked to being a relatively low quality business. Now, return on invested capital is interesting though, because we can see, if we exclude 2009, which looks almost like a startup type number, and we go to 2010 on, the first thing you notice is that they've been profitable every year of our financial data. You like to see that profitability. That's a very strong sign that they haven't lost money even in their worst year. Their worst year is 2017 with an 8% return on invested capital, but every year other than 2017, they've earned double-digit returns on invested capital, which is a very good sign. You can see the initial returns on invested capital were astronomical, 53.54%. But if we ignore that and just kind of look from 2013 to 2021, you can see it starts out at 18.7%, ends at 19.7%. Either way, you're basically running above a 15% invested capital. 15 to that 20% range seems to be where it's operating. And when you can operate with a 15 to 20% return on invested capital, you don't need debt in order to grow, and you don't need debt in order to operate as a very strong business. I mentioned at the beginning they have net cash. That's a very good sign for a high quality business. Not only is it profitable every year, but you're operating at a very high return on invested capital. 15 to 20% is a very strong sweet spot for a high-end business. You can see that they've leveraged this into a 18% return on equity over the last decade, 13% return on assets. All of these numbers are astronomically good and immediately puts it into consideration for my watch list. Now, where I start to have an initial concern comes when I see valuation. A PE of 46 is extremely high. So the first thought I'm going to have is this high on its own, or is there other things along with it? Is this a one-time number? And we're going to dive into that. But when I just take a look here and say 2021, $8.15, let's see how that compares to current price, $3.26. So you know that you would then compare that to these other numbers, and you don't see any year that's higher than $8.15, which means that this isn't a one-time low year. In fact, their earnings seem to have been accelerating. They've gone from $1 in earnings in 2012 to $8 in 2021. So you've seen almost a 7 to 8x increase in EPS over the course of a decade. Anytime you have growth like this, you are on an investment that could do extremely well for you as a shareholder. A normal company might double its earnings in 7 to 10 years. This company is doubling its earnings in a couple years. I mean, you think in 3 years they went from $4 to $8, and they went from $1 to $4 in 7 years. Very, very good numbers here that I'm seeing, and makes me really interested in the potential for this business. This is not a normal setup for you as a shareholder, but it's very, very attractive as a potential investment. What that equates to is, of course, here you can see this EPS, 40% EPS growth over the last 10 years, 27% earnings revenue growth, 28% free cash flow growth. I like as well that the EPS is growing faster than revenue. That's telling you that there's some operating leverage going on. EPS growing faster than assets. They're earning higher and higher returns on invested capital because they're able to drop to the bottom line with some nice margins. So what you're seeing there is a very good leveraging of scale and a really interesting EPS growth. Now, I would not expect this to repeat, and that's where we start to become a problem. When you see a PE ratio like this of 46, price to sales of 4, price to book of 6.8, this PE is just too high for me. And it's not that this is a wrong price. Because think about what this would do. If you 8x over the next decade, then you're kind of trading at a PE of 6.5 of what your future decade returns are. And so then you could easily double your share price or more over the course of the next decade. You can earn 7 to 10% returns pretty reasonably if you repeat this sort of EPS growth. The problem is I would never pencil in this sort of EPS growth. Even if you just drop this to 15% or 20%, let's say it drops down to what your return on invested capital is, 15 to 20% growth, that would still be very, very good growth. It would mean you don't require debt to grow. It would mean you don't require dilution to grow. You're a very strong setup for that sort of growth. But that sort of growth is harder to justify this sort of PE valuation. I'd really not want to pay more than 20 times earnings for a business like this. Normally my cap is 15, but the numbers here are so amazing that I would consider paying a higher price, like a 20 times PE for a business like this. Because at that point, I don't have to worry as much about the share price contracting on a multiple basis. If you're trading at a PE of 20, you might trade at a PE of 20 at the end. But you trade at a PE of 46, you might trade at a PE of 20 at the end of the decade, which means you have to build in multiple contraction to be what your overall return is. And that's really hard to do with any sort of certainty. Now, if you just do the math, it's going to still pencil out. I mean, if you were able to grow at this rate and your PE dropped to 20 at the end of the decade, you're still going to probably have market-beating returns. The problem is, can you predict this? How much can you trust this to repeat going forward? And that's where I would struggle with it. But again, everything so far is telling me, hey, this is a great potential company. It's the type of thing you'd want on a watch list. I mean, look, gross profit went from $163 million to $1.2 billion in a decade. That's amazing. So let's go to the income statement and see what else we can figure out about this business to see if there's any more red flags or other things that would just make me want to buy the stock. If you're enjoying this video, hit that like button. Please hit the subscribe button as well so you can get all my new videos. I'm uploading 3 a week, and I'm working through the entire S&P 500 companies. So first thing I want to see here is the shares dilution. And so you see you've gone from 44 million shares outstanding to 59 million shares outstanding. So you've diluted about 30%? 30%? Yeah. 30%. So that's about a 3% per year, 3 or 4% per year reduction in your EPS because of that dilution. But it's not been a problem. I mean, you're still 5 or 6x in your EPS over the decade. So it's a case like this where I am not at all concerned about share dilution. It's allowed you to 8x your net income, which has been totally worth it for shareholders as you've seen the EPS grow accordingly. If we go to our balance sheet, we can see a few other things. And one of the things you can see is they are growing their assets a lot. You've gone from 35 million to 421 million. You've 10 extra assets over the course of the decade. That is a lot of asset growth. But if we just look at the PP&E, 421 million, and you compare that to the income statement, it's almost 100% return on your tangible assets there, which is incredible. Very high returns on assets. Your actual return on asset number is much higher than it looks because you have $600 million of goodwill and intangibles in this asset base, which is pulling down your returns. Also, some of the stuff that's pulling down your returns is cash. You pull the cash out, you pull the goodwill out, you put the intangibles out, and you're earning incredible returns on capital from this business. Very, very attractive. If you can grow that fast without increasing your capital base that much, that means all that money can be used to pay dividends, all that money can be used to do share buybacks. As the business grows, it's going to be very, very attractive to own for future shareholders. Let's look at our debt here. Again, basically no long-term debt. It says 25-30 million there, but you have $1 billion in cash. So you have net cash out the wazoo. It's very, very incredible there on the numbers. Cash flow statement, anything seen here that makes this look off? No, you're starting to see some depreciation and amortization increase over time, but that's because of these investments in PP&E. I'm not really concerned. They don't really spend a lot on acquisitions, so that's not a concern. You can see they're not really doing share buybacks or other forms of financing. All this money is being reinvested, and I think that's totally applicable. When you're able to grow at these high rates of return, you should absolutely keep doing that. You don't need to worry about sending out money to shareholders if you're actually getting such incredible returns. When you get this sort of growth rate and these sorts of returns, you want to reinvest in the business, and that's exactly what I would want as a shareholder from a capital allocation perspective. So to me, EPAM Systems was one recommended from one of our YouTube audience. So thank you for that recommendation to check it out, because this was a really interesting interesting company to look at, and I think it goes on my watch list. It's on my watch list and not into my portfolio because the valuation is just a little too high. I would like to target something closer to the PE of 20, which just means it's almost double the price that I'd be super comfortable paying with it. But if you're able to get comfortable with it, then that's on your assessment of what the future could be. But I really like the numbers I've seen from the past here. Very strong returns on invested capital, very strong growth rates, good margins, and I like that they're growing without the capital, because these numbers are actually lower than they should be. If you pull out the cash, you pull out the goodwill, you pull out the intangibles, the tangible returns on assets are incredible in this business. And so I'm excited to put EPAM Systems on my watch list. You enjoyed this video? Hit that like button. Please subscribe, and you can check out the playlist at the top for all the other watch list companies that I have covered in the S&P 500. These are the best stocks I have found in the S&P 500, and I think you will learn a lot from checking them out. If you want to learn to use the software that I am using myself for my assessments here, it is quickfs.net. Tell them Trey sent you, and the affiliate link is the first link in the description below. So please check that out and use my link. Thank you for listening, and until next time, stop paying fees, start building wealth.